thanks everybody to be here, and I very much commended this endeavor and support from the ECGI and the Kelley School of Business and Indiana University, because this public lecture series will precisely here to stimulate as well as discuss the emerging topics in the corporate governance area. So I'm going to talk about how data and the technology are going to reshape or redefine corporate governance, a very, very old concept that we have known for a long time. Now, I decided to omit the word big because we've been talking about big data all the time. But in the end, I figured out there's really no official or accurate definition of what data is big or not big. So I just group generally as just information contained in data. Okay, so when one talks about corporate governance, many issues could instantly come to your mind. You could think about board election. You could think about executive compensation, related party transactions, and more recently also about leadership diversity or sustainability. But if we abstract from all these discrete issues, it is really about a set of processes, customs, policies, laws, and institutions that will determine how a corporation is going to be directed, managed, and controlled. Now, if we ask ourselves, why do we even need corporate governance? Now, fundamentally, I think it's probably because of these two reasons. One is that as we are all economists, we assume that human beings are primarily self-interested, not self-interested necessary for the narrow monetary benefits. It could be broadly defined in utility terms, but we are here mostly to pursue our individual welfare, a good sense of good feeling, etc. Hence, the separation of the ownership to the large, diversely owned corporations and the actual control would inevitably introduce the conflict of interest. Now, the second source is information asymmetry, and usually defined between what insiders know and what outsiders know, or what outsiders can infer from the insiders' actions. And what we are going to talk about is that how technology will really, really change these constraints and these relations. Now, these two issues have led to the current system of corporate governance, which we called a very board-centric version of it. So if you think about a corporation, now CEOs and senior managers are effective controllers. They control how the corporations run and operate it on a day-to-day basis. But the real boss is really the board, including the directors on the board. Now, theoretically, the boards are elected by shareholders, and sometimes shareholders may them have more inputs than the others. And then we also have all these yellow circles, which are external monitors, stakeholders, as well as gatekeepers. So this is the system of corporate governance that we are very, very familiar with. Now, the question is, where does technology fit? Which circle will be impacted by technology, or which link or arrow will be impacted by it? So I'm very, very excited these days because I feel, as we know about the tech around us, it's also true that technology is bringing many, many new chapters to corporate governance. Now, only have about 45 minutes. I can outline, I think these are the three biggest issues that will connect technology with corporate governance. The first is about corporate governance with data and technology. Now, what is the new information serves additional governance role? What kind of innovative toolkits can we aggregate information? Can we aggregate shareholder and stakeholder preferences? And what are the infrastructure that could be improved by corporate governance, so for certain execution to make it feasible or better? Now, you can also talk about a complete separate, not complete, but almost separate strand of issues, which Professor Shackelfield and Professor Best also mentioned, is the governance of data and technology. Now, here we're talking about who owns data. What is a privacy issue? What does data monopoly mean? what are the biases in the algorithms? And also recently, there's emerging topic of AI ethics. So I very much look forward to more research or even more lectures in this series, because I think this is really, really an important and burgeoning issue. Now, the third part, I feel a lot of our colleagues, scholars in corporate finance or corporate governance have already been doing, basically is using big data and machine learning techniques to construct new measures or to develop technical or statistical inferences that are incremental, even replacing the traditional regression methods. So this has been under the way already, and I certainly anticipate that this will continue to evolve and to progress. Now for today, I'm only going to be focusing on the first part. It's about governance with data and with technology, and what are the new things or better things we could do. And for that purpose, I will be focusing on three parts. One is that the nature of the information has changed, and we will redefine information advantage and information asymmetry. Now, the second one is that with emergence of distributed ledger technology, now blockchain is the best known version of it, it really, really empowers shareholders because we are able to aggregate and execute their preferences, even the small retail investors. Now, the third part is about smart contracts. Now, smart contracts really expand the contracting feasibility space. So many things we thought we have to rely on incomplete contract or rely on renegotiation now could be executed or implemented without much ambiguity. So these are the things that are not going to change, not only going to change corporate governance, but also will make us rethink what should be the board-centric model adaptation to all these changes. So let me first focusing on the new paradigm of information asymmetry. Okay. So here I think there are various ways. That's how I see that how information as well as informational advantage should have been redefined. Because governance issues in most cases are invariably related to asymmetric information. Like someone did something, but someone else was affected, but don't know or do not know the full extent of it. So this is precisely, we often said, sunlight is the best disinfectant, because if everything is publicly observable, is completely transparent, probably a lot of the governance issues would have gone away, or at least mitigated to quite a minimal extent. Now, where does asymmetric information come along? The best known and probably still the most important paradigm that obviously there are many numerous work in this paradigm, but let me just start with the Myers-Majorov, the seminal 1984 paper. And the famous quote from that paper is, there's something when firms have information that investors do not have. So when firms have information that investors do not have, that will create a lot of frictions in raising new capital, especially raising equity capital, in making M&As, and in making investments, and even paying dividends. So they're all centered on investors so afraid that firms are hiding something away from them, despite investors are the ones taking the heat. Now, earlier on, before this big data and technology issues came along, I worked with co-authors in two papers. One is with Itai Goldstein and Chi Chen, the others with Alex Edmonds and Itai Goldstein. And in those two papers, we suggested that oftentimes firm managers actually learn from the stock price in their decision-making. And information in the stock price we show in our paper was incremental to what they already have known. And hence they will modify their investment policies or M&A decisions based on the reaction from the stock market or based on the valuation change in the stock market. Now, a decade ago or many years ago, when we presented these two papers, there's always challenge from this audience. Say, how would you say that somehow the outsiders know something that insiders don't know? Didn't Myers Modulus told us that always insiders know something that outsiders don't? That is the information asymmetry people have been focusing on. But time has changed, and I will show that today, if we were to rewrite these two papers, we will have a much stronger ground to argue that many informations generated from outside the firms were actually new or incremental to the managerial information. Now, the second part is that if you think about the law and the regulation, the creation of the SEC was motivated by the fact that we needed the information ground to be reasonably leveled so that most participants will feel comfortable to participate. Otherwise, the market will be incredibly thin to the extent of being dysfunctional. Now, what this regulation is about, these regulations are always about material non-public information obtained from a source that owes a duty of trust and confidence to the firm. Meaning, so far, the information regulation of the law targets information that's sourced or even leaked from inside the firm, from someone who is not supposed to leak such information. But what if the information now actually is created outside the firm, how such information should be interpreted or regulated? Okay. So here I would outline the issue into two separate parts. One is truly information created outside the firm, which I group in the category of alternative data. And second part is that we will still focus on the traditional disclosure data, but the nature of its processing also changed with technology. Now, what are alternative data? So alternative data really generate outside the firm by tracking footprints. So when I put footprints in the quotation marks, I really mean it literally as well as figuratively. The footprints could be real footprints by customers walking in the store, as tracked by satellite images, could be internet traffic, could be credit card scan, could be Internet of Things sensors, could be social media postings. And various research actually show that this information could be ahead of managerial information. So it could be that the Starbucks managers did not know how much sales they have accomplished, while the satellites already have a better information before the management get the aggregation information from their own firm. Or it could be incremental to them. They know something, but these footprints yield some even more information. Now, the interesting part of this alternative data related to governance issue that the access of such information is universal. Anyone, nobody has a monopoly over it. If you pay certain fee, if you install certain technology, you can get it. But on the other hand, the access to such information is also very uneven, because depending on the skills you have, the resources you have dramatically unequal capacity to actually utilize information to your advantage when the information becomes more abundant. Now, the same issue also applies to the traditional data, the ADGAR SEC filings, the press releases, the IR presentations. Now, I checked the SEC website, so it turned out that every year, the ADGAR website is serving 3,000 terabytes of information every year to the public. Now, what do these 3,000 terabytes mean? How much of a human brain can absorb in a lifetime? So I ask this question to a life scientist, say, given I'm a reasonably intelligent person, given if I take very care of my brain, how much gigabytes, terabytes, or other higher units of information can I absorb in my lifetime? And the answer is 2.5 petabytes, or 2,500 terabytes of information. So we should all keep learning, because there's 2,500 terabytes information waiting for us to be absorbed in our lifetime. So my point is that the information housed by the SEC in a single year slightly exceeds the total capacity that one human brain can absorb in a lifetime. So clearly, this is not the information, the type of information meant for human beings to process in time to make the decision. There's a very interesting recent 2020 JF paper by Cohen, Malloy, and Nguyen, and they actually show the length of 10K, the annual filings, increased by 5 times in the 12-year period, ended in 2017, and also the incremental year-to-year tax changes increased by 12 times. That is really, really a challenge for the normal mortals. Now, obviously, a lot of these filings are not read by mortals. The SEC posts its own estimate that about 85% of the documents visited are by internet bots. And my own research with co-authors came up with an estimation that's very, very similar. So here we're talking about public information, universally accessible, but the differential ability to process this big data creates a new form of asymmetry, despite their being public. And neither form of the information asymmetry are listed on these slides could be mitigated by regulation like Reg FD, because Reg FD, Fair Disclosure, just ask a firm to release some information simultaneously to all investors when firms would do, but it's not leveling the ground among all investors. Okay. So let me start with the alternative data. So Christina Zhu has a very interesting paper published in the IFS, and she shows that externally generated alternative data that includes the clicks, the conversion, and satellite images. These data became quite popular during a 3-year period around 2014 to 2016, but they're staggeringly introduced to different firms, offering a very nice set for difference in different type of analysis. And not only she shows that these data are predictive of firm performance, but she also showed importantly that such information is offsetting the insider information advantage. So the stock prices become more informative, but also the management enjoys less rents from insider trading because suddenly their information is offset by this data generated from outside. And finally, the firms now have better alignment of investment with the fundamentals, meaning the management is also learning something incremental from this external data, making their firm level decisions. So not only about, so this is mostly about customer data or B2C data, but we can also think about the growing data could provide information on ownership structures, leadership qualities, shareholder sentiment, employee satisfaction, as well as government's risk. Now, currently, one of the hottest issue, which the previous speaker, Professor Alex Adamans, focused on the ESG. So he mentioned that there are dozens of ESG metrics floating around with very, very low pairwise correlation. But I'm actually hopeful that these metrics will gradually converge because with the data technology, we're no longer textual processing to see whether the firms talk the talk. We can actually measure whether they walk the talk. We can have actual ESG metrics like the emissions, the abatement technology, the air quality, the water usage, etc., and also the real-time employee satisfaction. So gradually, I think we will have better and better metrics so that we can hold the firm management more accountable, responsible along these important metrics. Now, I have a new paper co-authored with Xiang Chao, Junbo Wang, and Baozhong Yang. And what they show is that the alternative data indeed brings informational advantage, which also complement and reinforce the finding by Christina Zhu. So here we did an event study, okay? Basically say between 2014 and 2016, more and more firms have themselves being covered by these alternative data, could be credit card scans, could be satellite images. Now, what would be the analyst forecast performance change after these target firm becomes covered by the auto data? Okay. Now, how do we benchmark them? We benchmark them against the AI facilitated forecast that based mostly on firm disclosed information. So what we find, the most interesting part is a highlighted coefficient, which is a triple product. So it has the event of the firm become covered by auto data. It is post after it is covered, and further, it has to be interacted with the brokerage firm, which the analyst is affiliated, is also have AI capacity is measured by AI hiring using the burning glass data. So what it shows is that if an analyst is hired by brokerage firm that have AI capacity, then they suddenly have a huge boost in the performance of forecast capability after the coverage relative to a benchmark that relied on firm disclosed information. So this is another clear evidence that how more and more information is actually generated outside the firm rather than being processed from the firm disclosure. Okay. Now, this will lead to more and more internet bots to chase after the public information and create more public information asymmetry. So this is a different paper I had with three co-authors that show what's the percentage of the SEC website data retrieval was presumably pursued by internet bots or machines. And you can see there's a very straight up increase in the percentage, and in the most recent years is around between 80% to 90%, very close to what the SEC is estimated. Now, firms are not a passive party in this change, and firms are accommodating the increasing machine readership by making their files more machine readable. So the right panel is an index of the filing being machine readability based on the ease for textual analysis by a standard algorithm codes. So you can also see the filing have become machine readable in accommodation to the increasing machine downloads or machine readership. Now, what does it mean? It means that the information is disseminated into the stock price even faster than before. Here, we are measuring the time to the first trade in the unit, these coefficients are in the unit of seconds. So the time to the first trade in the unit of seconds after a filing is deposited on the SEC. And you can see when the machine downloads in log scale, so 1 unit, when the machine downloads doubles, the time to the first trade is shortened by 7 to 8 seconds. Now, the time to the first directional trade, meaning is the first trade that is profitable based on the stock price 15 minutes after the filing. So the time to the first directional trade is shortened by around 10 seconds for every doubling of the amount of machine downloads. Moreover, when the firm's making the filings more machine readable, you're like giving the machines steroids. They read it even faster. So this is to some extent good news because the public disclosure is for the purpose of having the information being disseminated, impounded in the stock price. So that stock price would reflect the firm fundamentals. Now, a side effect is, in fact, increased information asymmetry due to the release of public information in the sense of widened bid-ask spread. So what we find, this is with filing fixed effect and a minute fixed effect from 15 minutes before to 15 minutes after the filing being deposited. You will see when the machine downloads doubled, the bid-ask spread would increase somewhere between 3 to 8 basis points. And this is a meaningful number when we talk about market liquidity, meaning overall, actually, there's the market maker or traders in the aggregate realize some people have a information advantage over them when precisely when public information is released to the market. Okay. Now, a further issue is that now, because the machines are reading the files, and the firms realize that the machines are reading the files, and they're going to change the way they talk. So a related work that we're working on is that if the agents have vested interest, then they will have the incentive to change the way they talk if you know the machines is listening. Now, we know that a lot of companies are hiring people using robots to conduct first round interviews. Now, if you go for such an interview, you should train a machine. You should go to train yourself till you get a high mark on such an algorithm before you will show up on an interview. And I think the firm will do the same. At this quote from institutional investors, even 5 years ago, they realized that. So basically, if the machines are working so hard, mining the transcripts of earnings calls or 10Ks, and successfully in doing so, trying to figuring out the prospects and sentiments, then the management at those companies probably should catch on, attempt to change the signal that they're inadvertently sending. So they will no longer be inadvertently sending signals, but they will be purposefully sending the signals. And one event study that my co-authors and I did is to look at an event, which is the publication of a seminal paper by Locker and McDonald's. So Locker and McDonald's published a list of vocabularies in the finance context to decide which is positive and which is negative. The financial context is important because words like liability is a negative word in standard dictionary like the Harvard Dictionary, but it is a word appearing in every single balance sheet filing. So hence they will reclassify to meet the needs and motivations for financial analysis. Now, again, once the dictionary was published and was fed into numerous algorithms, certainly by academics, perhaps also by practitioners, as we found white papers by prominent asset managers and hedge funds that are using this algorithm or lexicon as well. Now, what will happen? So here is a very nice parallel trend testing and as well as the difference in difference analysis. Here, the blue line is SEC filings by firms with the top 1/3, top tercile in machine downloads. Bottom tercile in machine downloads, and the red line is the top tercile machine downloads. And this measures the frequency that these filings will contain the Locker and McDonald's negative words with fixed effects fixed out, time and other fixed effects taken out. What we show is that before 2011, before Locker and McDonald's determined that these words were negative, they were used with equal frequency, but after the publication of this inferential dictionary, then you will see that firms that are more chased after by machine readers tend to avoid using these negative words more often. Now, while this could be an interesting, cute story on its own, what I hope is to make a more general point, because this indicates there's a feedback effect from machine learning about firm fundamentals to corporate decision. Because when we do machine learning, even deep learning or unsupervised learning, it is rule-based. Whatever machine does is rule-based. And encoded rules are at least partially transparent or somewhat reverse engineerable. And hence, the agents who are impacted by the decision rules would have incentive to manipulate inputs to the machine learning. And hence, the more machine learning we do in our research or in more importantly, in the actual decision making, the more we need to take into account of this feedback effect, which does not quite happen under the board-centric or human decision rule, at least to a much less degree, because it's not mechanical or code-driven. Okay, so let me now move to part 2. is about how the new foundational technology epitomized by blockchain could help us better aggregate the opinions of shareholders and offer more transparency in ownership as well as in voting. So when we talk about voting, voting is really the building block of shareholder democracy. Now, on the left of the picture, this is what we call what I learned from the course of Western civilization. This happened to about 500 BC. This is Athenian democracy, when citizens vote directly on important policies. So its analogy of the direct democracy in corporate governance is really a shareholder voting on the outcome. So we could view this as a shareholder proposal, say on pay. Now, a few hundred years after the Athenian democracy, there's an alternative version of democracy, which is a Roman Republic. So this is also called a representative democracy. Then citizens elect their representatives who will in turn make important decisions. So here, the analogy in corporate governance is where the shareholders will elect board directors who will make important decisions for them, so shareholders can go to work just like I'm doing now. So in this, we'll be talking about board elections of proxy context. So this is why we can view corporate governance is a mixture of Athenian democracy and Roman Republic. And in fact, in recent years, we are moving more and more in the direction of an earlier version of the democracy or direct democracy, because shareholders are having more and more of a direct input in the corporate affairs. Okay. Now, while we welcome shareholders' direct inputs into corporate affairs, then we immediately bump into the hurdle of technology. How can shareholders express their view, and how can we know that their views and preferences are properly recorded and aggregated? So here I would list 3 major blunders in the recent history of corporate governance. So the first one is a prominent asset manager, T. Rowe. They voted against Dell Computer going private transaction in 2013. So the accusation is that the CEO of Dell Computer, which is also Dell, Mr. Dell, underpaid or underballed the shareholders in a going private deal. So he and Silver Lake, the private equity firm, paid a price that's supposed to be below the fundamental value of the firm under the new regime, and try to accrue all the benefit mostly to themselves. Now, mostly in transaction deal, mostly, shareholder votes almost like a rubber stamp. You get predominantly overwhelmed support, because after all, if you're target of a takeover, you get on average 30% premium, so shareholders would welcome that. Now, in this particular case, 30% of shareholders voted against the deal. That's a very sizable dissension. Now, what do you do when you dissent against a deal? If you dissent against a deal, you will refrain from voting and you surrender your shares to the court, and the judge will give you a judicially determined fair value. So I have a separate paper on this topic. So the thing is that T. Rowe thought it dissented and filed an appraisal petition, but later were informed that the voting instruction were in fact for to voted for. So by the final account, it already voted for the transaction. Hence, its shareholders were deprived of the value improvement from the later appraisal. So that was a big embarrassment of the T. Rowe, being such a well-resourced institution, but couldn't track how and whether it voted its own shares. Now, a more interesting story in the same year is the CEO of Dole Foods, who apparently or allegedly used very dubious share lending, empty voting, somehow voted out a management buyout deal similar to the Dell Computer. And later, there was a class action lawsuit say, hey, you really, really underpaid us. So in a settlement, the CEO, former CEO of Doufu, decided to compensate the shareholders for the underpayment. Now, 134% of the shares showed up at the table and said, "Give me the compensation." So apparently, shareholders don't know who actually owned the shares at the record date because of an overwhelming volume of short selling. So a lot of shares were lent out, but shareholders still thought they owned the shares. And the bona fide buyers from the short sellers also think they legitimately have the right to the share, to the compensation. So it took the court a long time to figure out who actually has the right to the compensation or not. I think in the end, they probably compensate them all. So there's a paper by Aaron Smith that shows such overvoting. Overvoting is basically double voting. A share could be voted twice or 3 times or many, many times. And she identified that amounts to 4% on average. But in this Doe case, the overvoting, the lower bound is 34%, even you assume 100% show up. So in this case, the Aaron Smith also show when you have more overvoting, there's also a pro-management bias. So somehow the management get to mobilize more shares. And when more shares showed up to vote, the outcomes are more friendly to the management. Now, what can we do? And the similar case happened in proxy context. So in a paper with Alon Braff, Tao Li, and James Pennington, that we showed that proxy context or contested board elections are incredibly pivotal. So conditional on voting, the dissidents won 49.5% of time. And when the leading proxy advisors like the ISS issue a recommendation, they support dissident 52% of time. So when I highlight these two numbers, I just want to show these numbers are statistically 1/2. Just say conditional on a proxy context, they're incredibly close. Now, in the 2017, there's a proxy, high-profile proxy context between Twine and P&G. And initially, the first count was 0.2% win by P&G, and later was counted as 0.0016 win by Twine. Now, who wins? We actually don't know. From the Council of Institutional Investors letter to 2018, they basically say anywhere between 45 and 55, there's no verifiable answer to the question, who won? So in the end, P&G did not concede, but they allowed the Twine representative to be on the board as a settlement of the case. So it's a case more like a settlement rather than a definitive win. So here we are calling for help for blockchain to fixing this plumbing, because the shareholding records is just as involved as the plumbing of the pipes to the picture to the right. All our shares eventually be held at DTC, and depository trust company. When a voting will hold place, the depository DTC will go at least 3 layers to inform the beneficial owner for them to come out to vote. But who knows who will actually vote, or who will double vote, or the broker thought they are the voting party and the beneficial owner also want to vote. We just don't know. Now, why would the technology would help? Because what is the defining function of a blockchain? A blockchain is finally successful because it used technology to solve a very important issue called the double spending. So when we use paper money, you can never spend the same paper money twice. But when money is digital, it's very difficult to prevent from being spent twice. And blockchain is the technology that so far successfully resolve it. Now, we can also use the same technology to solve double voting because the mechanism or analogy is exact. And David Yermak had a 2017 review of paper that shows detailized how blockchain could help with the transparency, accuracy, and immutability of ownership. Now, we can go beyond the voting and think about with blockchain, our voting schemes could have very enriched features. For example, we can implement tenure-based voting. So we talk about the dual class share. Most people think it's unfair. Why should some shares have more voting rights than others? But we can design a scheme where you own a share for another year, you can gain one more vote, up to be sealed at 5 votes per share or 10 votes per share. But such tenure-based voting will require the technology similar to a blockchain or a distributed, immutable distributed ledger, so that we can record the tenure of each current share. We can also have voting power of outside shares to be contingent on some verifiable firm performance. We can also have contingent sunset of dual class shares, meaning if the firm reaches certain maturity, then the dual class should be automatically converted into the single class. Now, I also recently talked to some entrepreneurs, and they are talking about setting up DAOs, or decentralized autonomous organizations, to aggregate the preferences of retail shareholders so they can vote on certain proposals, especially ESG-oriented proposals, because they can express a very clear preference. And they will be their own proxy advisors rather than rely on institutions like the ISS. Okay. And we may be heading for an age of radical ownership transparency. Now, blockchain doesn't mean you lose your privacy. The blockchain could still offering various degrees of anonymity, and the various degree of privacy can also compete and attract clienteles for listings at the different exchanges of different types. And we should think about, even if you have the most decentralized technology, like complete anonymity and arbitrary number of digital warrants per investor, the blockchain system, the identity will still be traced to a level accomplishable by the current tape watcher. So blockchain actually does not necessarily compromise more privacy than the current system does, but it really publicizes the information that is currently only watchable, observable to the trader, the tape watcher, to basically to anyone who wants to know. So it's more a leveling of the ground rather than additional compromise of privacy. And we can also have particular type codes. So instead of certain defiling, you could have a 5+ block holders will have a different type code on the blockchain, and insiders could be required to share their public keys as a way for insider trading regulation. So these are open up many new grounds for the regulation as well as the self-regulation of the market. And we may not see this again. So I pick out 2 extremely interesting stories from the past research. One is by Heron and Lear, and they show that CEOs grant stock options to themselves when mysteriously when the stock have this V-shaped dip. And David Yamak showed that CEOs donate their stocks to their own family foundations when mysteriously the stock reaches this very sharp peak. Now, if you think about when you have a publicly distributed ledger, and this record will not be reverse changeable, it will be immutable. Hence, we'll no longer see such interesting stories under the new technology. Okay, so I have 5 minutes left, and we talk about very briefly about this new contracting space brought out by smart contracts. So there are various definitions of the smart contracts, but I'm quoting our colleague Will Chung and Jiguo He in their recent 2019 IFS paper. So the smart contracts are really digital contracts allowing contingent terms and rely on decentralized consensus. They're tamper-proof, they're self-enforcing, and they're automatically executed. So they're really more robotic than intelligence. They're not intelligent at all. And it's not completely new in terms of the idea, because you can think about a vending machine or escrow account as quasi smart contracts. Going forward, you can think about, when a collateral deed record is deposited, the credit could be released immediately. Or insurance, when the temperature go above 95 degrees for 3 days, the farmer will immediately get overheating insurance. So these are the examples of smart contract. Now, what is the relevance for corporate governance? So one is that the smart contract mitigates the traditional moral hazard in the form of hidden actions, because with the sensors all around, we can detect or monitor a lot of hidden actions. Okay, so if you're afraid whether your wine delivery was delivered at a temperature below 20 degrees Celsius, you can have a sensor on each bottle and information will be sent to your iPhone. So these are the new technologies that make sure that the hidden action is no longer the paramount issue in the moral hazard in the contractual problem. Now, in fact, Will Chung, Jiguo He, and Jason Lee, in their 2021 IFS paper, it's a contracting issue, but effort is effectively observable, because even though solving the most difficult math puzzle is random, solving the math puzzle one level down is almost deterministic. So we are thinking about having more observable, traditionally hidden actions. We no longer need to have enforcement cost. We can deter strategic behavior because the execution is automatic and very rigid. But we can also think about what are the situations that's good for smart contract and what are the situations that's bad for smart contract. When you think about real estate foreclosure, you can have a smart contract. You say if you don't pay rent for 6 months, your property ownership deeds will automatically be transferred to the bank. But you have to ask yourself, if the delinquency is due to inability to pay the full amount, but there's still ability to pay some, you might want to renegotiate. But if the reason is a strategic default, that they are able to pay but will not to pay in order to extract rents from a waiver renegotiation, then the smart contract will be great, because smart contract is a commitment that you're not going to renegotiate with you. And the same thing, I can think about the COCO bonds or convertible contingent bonds. The COCO bonds could be triggered by a smart contract, meaning if a bank is in distress, the COCO bonds could be immediately converted into equity to beef up the equity base. But if the trigger is mechanic, as Sundaresan and Wang show, then you could cause a death spiral, meaning if the COCO bonds will be triggered if the stock price will drop, and the stock price will drop in anticipate of the triggering and actually trigger. So these are issues. I think the general issues actually are very nicely analyzed in Bond, Ghosting, Prescott, despite it's not about the big data technology, but they actually show if you have an external metric contingent intervention, then the intervention rule has to take into account of this feedback effect. And this is particularly relevant when we talk about the smart contract in the new technology area. Okay, so Jing asked me to end before 1 o'clock, and I think I'm at the conclusion stage. Data technology do wonder. Okay, so they solve problem, they create problem, but they're creating problem at a much higher level capacity and efficiency. So we should not be worried about problem, but just talking about how to deal with a new problem. Okay, and what I want to highlight is that I talk about 3 issues: new information acquisition, preference aggregation, and contractual feasibility. And all 3 issues will contribute to more empowered shareholders and the less need for a board-centric model. And this is what I view about how technology will impact corporate governance in general. A lot of exciting topics. I really look forward to future talks in this series. Thanks, everybody. Thanks, Marco. Thanks, Jing. Thank you.
Thank you so much, Wei, for giving us a wonderful and very insightful talk. And there are many questions. Some of those were raised before you touched the topic, so I may change the order. Let's see what you want to say. So the first one is from Justin Bancroft. How to validate transactions through the blockchain and ensure the proper accounting information is captured for financial reporting purposes, and how to extract it?
Yeah, so I think, just if basically the information, so suppose we're still using ADGAR as the most authoritative basis of information. So anytime a piece of filing touches ADGAR, that information could be automatically tracked by any chain or any ledger that one wants to capture. So the same thing you will see, like the engineers track the COVID around the world. How do they know COVID around the world? They basically look at the very decentralized units reporting COVID cases and they automatically track those and aggregate. I think that's pretty much the same level, the same type of technology.
All right, thank you, Wei. The next question is from Wei Wang. Wei was asking for alternative external information generation. Who assume the costs of information generation? Are they fairly compensated?
So that's a very, very interesting question. So far, I think is that people who want to benefit from this information will initially pay for the cost. So it's initial the vanguard, basically the vanguard of the alternative data, the super smart hedge funds, they were pay huge dollars from the alternative data vendor. But later on, it becomes a rat race, becomes arms race. So I bought information not because I need to get the advantage, because I don't want to have the disadvantage. So very quickly, it becomes a cost that everybody bears, but nobody's quite in getting ahead. But there'll be a next round of arms race. So I view currently the alternative database from being a cutting edge information into something more like a rat race, but we're looking for the next wave competition.
That's a very interesting observation. Yes, we're getting there. Mm-hmm. So next question is from Angela Polk. Angela was asking, how would you consider the relevance of data and its access by investor type and or holding periods? For example, algo-driven hedge funds versus fundamental long-term value investor.
Very good. So I think the goal is that eventually we will give this choice to investors. So basically firms can issue multiple class of shares, not by voting class, by anonymity. So if you buy certain class of shares, your every transaction could be observable, some are observable to the public in real time. And you will also review your code, your type, or you want a super privacy type of shares. And we'll just let these shares trade in the market and see differential prices and people are willing to pay for this. So I think there's more room to cater for different clienteles of investors beyond the voting rights. It could be sorted on many different things. I view this as the future. Yeah.
All right. So the next question is how machine may help board of directors to take more precise decisions.
So these days, there are a lot of research called AI assisted board, or even called autopilot board. So I don't think we are going to the autopilot board. Some engineers go to such extremes, say we no longer need a board. We basically need a robots who process information, spit out decisions. So I don't think we're going that far. Now, I think one is, I would think that two trends. The one trend is that board will give more and more decisions to shareholder vote. So on top of the M&A control related thing, if something big happens, instead of the board say the six of us come up with a decision, just say, let's cross our wisdom. And because it's a better system of the voting plumbing, we can aggregate the preference and voting out in accurate and transparent way. So this is the one trend. And the second trend is that I would also think the AI assisted board is a trend. So we're not using machine to replace human beings, but we are using machine to help the human beings to make decisions to be more quantitative and more evidence driven.
All right, so there are many good questions. I'm picking a few more. So this is at the bottom. Will the use of smart contracts, which requires contractual completeness, be really for crisis management tools, as the economic reality is so diverse from the moment that contracts were formed? Will this be wisey? Should we have some contractual flexibility, which smart contracts might not be able to deliver? On the other side, I do see with good eyes smart contracts reducing the political discretion in COCO's triggers.
Yeah, exactly. So I actually think this is a very, very exciting new research topic. I really look forward to more researchers working on it. I also want to work on it more. So what we learn is that when you have a smart contract that is completely rigid, it's like facing discontinuity all the time because it's a very discontinuity situation. And when you think about a human decision making, we almost never make a very, very discontinuous. Like you never come as a cliff. Like one centimeter above your other plateau, the 1 centimeter below you're below off the cliff. That usually that kind of decision does not make sense. Now in the smart contract, I think there are two issues. One is that if the threshold is completely immutable and unmanipulatable, I still think that execution sometimes makes sense because you precisely want to deter strategic behavior. Like I am able to pay, but I just don't want to pay. I want to renegotiate with you. No, like you're just off the cliff. Now, the other parts is that if the threshold is something that is endogenous decided in the system, like the financial crisis, and that will go to the COCO conversion example that I just pointed out, then it could endogenously introduce a death spiral. So I would think in those cases, we need to be very, very cautious about using smart contract. And this is a very new topic, and I will not be able to articulate a couple of sentences, but I really, really look forward to more research on this topic.
So I'm going to ask two more questions. One question I want to answer right here is people are asking whether the recording is available, whether the slides are available. So if you have registered, I believe that's everybody, you're going to receive a follow-up email with the link to the recording and the link to the slide deck. So next question is, Professor Jiang, any blockchain system in place to solve the double voting issue at this point? What will the future tech-driven system be used by the players in the industry?
Very good. Currently, there's one firm that's already using it. That's called overstock.com. That issues stock on the blockchain. And there's a reason, because the CEO was so mad at the short sellers. Because the short sellers were attacking the firm left and right. And the CEO basically said, look, I'm going to issue shares on the blockchain so that certain movement you can see in real time. So they're already not only collecting vote on the blockchain, but also distribute dividends in digital token format on the blockchain. So it's not like existing shares will move on to blockchain, is that more firms can issue new shares in the blockchain and the digital token format. So I do see that this will come. Now, why is this moving so slowly? Because the most entrenched interest in this system does not quite want this to happen, right? So the most entrenched system, like as Aaron Smith did the show, because when you're overvoting, when the voting aggregates, slowly, not effectively, overall the outcomes more favorable to the manager. And also the existing players, proxy advisor, they have a huge stake in the game. But however, because the technology is so inevitable, and I also see institutions like the ISS and DTC, they're all talking about blockchain and new technology. So I think eventually we will go there, because eventually people realize if you don't do it, then shareholders will do DEOs, the DAOs themselves.
All right, so the last question I'm going to ask, there are a few questions related to AI ethics. I'm going to leave that to future lectures. So I think Scott will cover that. So I'm going to ask last question related to your topic. How big data technologies, when carefully used by active shareholders, has the big data technologies, when carefully used by active investors, shareholders, the potential to reduce information asymmetry gap? There are several questions about information asymmetry. Because you touched on that, could you please answer these questions?
Yeah, so I think the technology does both. Technology makes so much information universal, makes so much information, meaning anyone who cares will know. You no longer have any insider privilege or the formerly certain classified information. Now you can observe if you want to know. Now, on the other hand, it also showed that resource and skill and capacity would play a more important role, and they actually will create new source of information asymmetry. Now, I actually think, that it doesn't mean the retail shareholders are always priced out, because retail shareholders, they themselves could be technology vanguards themselves. But I think, just if you're just watching the chart and try to trade, I certainly would advise against it, because for sure you'll be losing against those smart people or smart machines.
So many people wrote in their comments, that's a fantastic topic. So thank you for that. So let me wrap up today's talk with some concluding remarks. So I'm doing the full screen right now. So my brief summary of Wei's talk for today, there are three aspects. One is directly on information asymmetry. For the same information, because technology may increase the differential information processing capacities, so technology may actually exacerbate information asymmetry. So there is a downside of this. And enhancing disclosure, usually that's our regulatory change, may only make the matters worse in this case. So that's kind of information asymmetry. There is a double-edged sword. So the second thing is blockchain technology improves record keeping, and that will prevent overvoting, misreporting, options backdating, or many accounting frauds. I think that's a good thing. And the last one is smart contracts can solve many problems, especially can remove the need for trust, which seems to be in short supply in the society around the world these days. Smart contracts can enlarge the contracting space, but Wei also mentioned that it's probably more robotic than intelligent. So there's a big discussion we already had. We also mentioned the three aspects. She touched on only the first one for today. The first one is governance with data and technology. The second one is governance of data and technology. That's the data ownership, privacy issues, algorithmic biases, AI ethics. So we have questions on that. So that'll be our next talk. Scott, my colleague from Cali and executive director of Austrian workshop, would lead that discussion, and cybersecurity. So that's going to be another direction of this overall theme. And we also mentioned how would big data machine learning technologies affect corporate governance research. So let me elaborate a little bit. These are more our lecture series for the spring 2022 and fall 2022. So the first one is going to be cybersecurity and risk management. Can we eliminate cybersecurity problems, or should we try to manage it? What would be the technology perspective? What would be the legal perspective of these questions? The second point is raised by Wei, actually. Governance on blockchains. If someday or when investors own tokens and coins instead of securities, what would be the corporate governance? Because we're talking about a whole series of processes, rules, laws. So when the fundamental elements are changed, how would corporate governance look like? So that's also is going to be a very meaningful discussion. And lastly, what are the benefits and costs of using machine learning technology or big data in general? For example, can machines help extract and process tax-free information? What I care the most for corporate governance scholars is proxy statements. It's not 10K. With proxy statements, it's really messy. If anyone study annual incentive plans, you will have a huge headache on how to extract any data from that part. Can machine do better than human? And can we use technology to prevent fraud? Smart contract seems to do that. Before we use smart contract, can we use machine learning to detect fraud more effectively? And lastly, there are research on that. Can we rely on machine learning to select directors or even to appoint CEOs? And what might be the legal implications of these actions if we choose to do so? There are other challenges beyond data and technology. So we're going to touch on this in the future lectures. Climate risk and sustainable growth. So we're going to take the perspective of institutional investors. So we're going to have top scholars and institutional investors to have a conversation on this topic. And next one, which may be more than one lecture, is governance by activists. What's the role of hedge funds? What's the role of mutual funds? They tend to be labeled as active investors and passive investors, but actually that's may not be such a clear cut. And what are their dynamic relationship? So again, thank you all for coming today. Thank you, Wei, for a wonderful and very insightful lecture. I cannot find a better person to do this than you. And thank you, Marco and Scott, for hosting this wonderful series. The next lecture or the next event will be in the first week of February of 2022. Stay tuned. If you have any questions, any suggestions, any proposal to participate or to give a talk in the series, please email us at icg.indiana.edu. Again, thank you for all for participation, and good afternoon and good evening to all of you. Thank you.
Thanks, everybody.
Thank you, June. Thank you.
Thank you. So that's the end of today's event.
Yeah.
We will follow up with recording and slides. Thank you.